Hello, everyone. Happy Tuesday. Thanks for joining us today. I'm Sinead Gleason, Commercial Solutions Lead at Equifax Canada. And although in real time today, it's the middle of June, and we get to enjoy a brief few months of nice weather and sun. For the next hour, we're going to look back on the cold first quarter of 2026 as we dive into the Q1 business credit trends. So if we stroll back along this wintry memory lane, you might recall that during the dead of winter, Toronto Pearson Airport recorded its snowiest January day in history, which caused massive flight cancellations. And by March, there were disruptions in the global fuel supply with the closure of the Strait of Hormuz. Canada reached its 2% of GDP defense spending target. And recently, StatsCan data showed that we entered into a technical recession at the close of the first quarter, confirming that the economy had entered a prolonged period of stagnation as we saw the fifth consecutive quarterly drop in business capital investment. And as we dive into the credit trends, we'll see how business credit was impacted by all of that and other macroeconomic factors that played out in the first quarter. And a little later, I'll be joined by my colleague, Gianluigi Duella, Senior Director of Scoring, Engineering, and Insights here at Equifax Canada. Gianluigi is going to share some great insights on the credit profile of business principals. So think like owner, operator, sole proprietor, self-employed, that type of thing, which is a segment we've never really been able to drill into to this degree before. So we're excited to share some of those insights with you all today too. But I'm getting ahead of myself, so I'll pause here and pass things over to my colleague, Jordan, to take us through some housekeeping items. Jordan, over to you.
Thank you, Sinead, and good afternoon, everybody. Thanks so much for joining us today. As Sinead said, my name is Jordan, and I'll be one of the team behind the scenes helping to answer your questions. But first and foremost, I'm here to help navigate the webinar display you see in front of you. First things first, if you are having or have any issues with the video or the sound, please click the help button in the bottom left corner of your screen and run through the steps. All the way on the right side of your screen, there is an ask a question box. As always, feel free to click that box, enter any questions you may have, and we'll try to address them throughout the session today. In the event that there are too many questions to get through, we'll reach out to you individually to follow up in the coming weeks. In the box marked polls, you will see one that asks if you would like to be contacted by an Equifax representative. If so, click yes, and we will get in touch. If I could ask you to click on the box called Apps in the lower right corner, you'll see a couple of different options. The first one we'll talk about is links. In here, you will see a link to our new and improved Business Credit Report Direct page, as well as our survey. As I always say, even if you filled out one of these before, we'd love it if you took 30 seconds. Let us know your thoughts. We appreciate it. Lastly, in that app section as well, you'll see handouts. There are a few downloads, including today's presentation in English and French, if you'd like to follow along, and the Business Credit Trends Report. You can get it here first. Now, that is all from me. If you are ready to go, send me over a thumbs up. And Sinead, back over to you.
Great. Thank you very much, Jordan. All right, let's try and advance these slides. It takes a second, so let me try again. There we go. Okay, so first up is the big picture, macroeconomic data. These next few slides here really help set the stage of the environment that Canadian businesses were operating in during the first quarter. Firstly, we're looking at GDP on the left and population growth rates on the right. And I mentioned earlier that Canada has entered into a technical recession. And if you watch the news recently, you'll hear lots of debate about that. But looking at these numbers, it's kind of understandable why there's such a debate. Our GDP has been greatly impacted by our population changes over the past several years. In Q1, we recorded the first annual net population decrease since 1867. And in the chart on your left, the red bars represent the quarter-over-quarter change in GDP at market prices. And then the gray bars represent the quarter-over-quarter change in GDP per capita. And you can really see how much those two data points vary each quarter as you compare that to the population change numbers on the right. As the population was growing, the red bars reflected that growth at market prices, although not on a per capita basis as it was not as strong. But once the population numbers started to decline, the GDP per capita numbers began to mirror the market price figures more closely, with the exception of the first quarter of this year, and hence, I suppose, that debate. But one thing is clear, and it's that these numbers confirm businesses are navigating a tough economic environment, and they have been for some time now. Okay, looking at inflation, this chart shows the consumer price index in the gray line, the industrial product price index in the red line, and the raw material price index in blue. So in other words, what consumers paid in gray, what businesses had to pay in the red, and what factories charged for finished goods, what factories charged for finished goods in red, and then what manufacturers paid for raw materials and raw ingredients in the blue line. And what we see is that businesses are experiencing a sharp increase in the price of raw materials. And these are things like oil and other raw commodities. Those items are getting very expensive for factories in a very short period of time. Industrial product prices, although they're also rising, it's been on a slower trajectory, around 10%, compared to the 32% spike of raw materials. And this illustrates that factories are trying to raise their prices to cover those raw cost increases. The good news for consumers is that on balance, the price index has remained steady. So those price increases have not drastically been passed on to Canadians. But what it means for businesses is that profits have taken the hit. Okay, next we will look at the international trade landscape. By March, Canada recorded a trade surplus as exports exceeded imports. And this surplus was driven by skyrocketing oil and gold exports. In terms of imports, Canada imported 2.3% less from the US, but saw increased imports from the EU, China, and Mexico. Whereas on the export side, we see another decline of exports to the US by 0.7%, but significant growth in exports to the UK, EU, and China. And then on the labor side, while the quarter started off soft, the employment rate held steady by March at 60.6%, and the unemployment rate was 6.7%. On a year-over-year basis, the average hourly wage increased 4.7% to $37.73. And the sector that saw the largest declines in employment was information, culture, and recreation, followed by the construction sector. And the largest gains came from businesses, building and other support services, healthcare and social assistance, as well as accommodation and food service. Notably for the self-employment rate, although we had seen some gains made at the start of the year, by the end of Q1, those numbers were on the decline. And I'm trying to advance the slides, so bear with me. Here, labor market, and then there we go. Active businesses. Okay, so overall, that's probably going to happen a lot throughout this thing, so just bear with me. Overall, Canada had been in a prolonged period of flatness in terms of business openings and closings. On the left-hand side of your screen, you see the massive impact that COVID had on business openings and closings, and that it stabilized around 2021. Since 2021, business closures have consistently matched or even outpaced openings. But when we look at the 3-year averages on your right-hand side here, we see where things really started to flatline. So after a brief growth period in 2024, 2025 netted out flat in terms of new businesses. And so far, that trend has ever so slightly softened further in 2026. And this flat line that we've been seeing is a bit of a concern, particularly, and we'll get to this a little later in the slides ahead, but particularly as we've been seeing a rise in missed payments by businesses. Slide successfully advanced. Okay, so next up is retail sales. And this slide tells quite a story, if you ask me. On the left-hand side, you have two trends. The blue line represents current dollar retail sales trended since March of 2021. And then the yellow represents retail sales dollars held constant at 2017 dollars. And so what that allows us to see is the change in the purchase power of the dollar. Sort of a visual representation of inflation, really. The bigger the gap between those two lines means that things are costing more, not that we're necessarily producing more. So while revenue in current dollars looks like it's been growing steadily upwards, purchasing power has actually shrunk a bit. And on the right-hand side, you see one massive outlier within retail sales growth, which was up overall by 0.9%. Unsurprisingly, gas stations and fuel vendors are almost entirely responsible for that overall growth, as that sector reported a significant increase of 12.4%. This growth offset losses by building material, garden equipment, and supplies dealers, along with motor vehicle and parts dealers and general merch retailers. Okay, so with all of that, a recessionary environment, mounting cost pressures, trade uncertainty, what we're seeing is that the number of entrepreneurs willing to jump in and start a new venture has stalled. But yet, in spite of that, in the first quarter, Canadian business owners were actually optimistic about the future. So let's take a look now at our latest Business Health Index numbers. So I'll start off by talking about what the Business Health Index is first before we dig in too deep. So Equifax has partnered with BDC to create a quarterly index that measures 4 key components. There's credit performance, business growth projections, business confidence sentiment, and then business environment. And it consists of a combination of survey data collected by BDC, Equifax Credit Bureau risk data, and then macroeconomic data from StatsCan and the Bank of Canada. And this quarter, the national index actually grew to 100.9%, which is awesome because I didn't think it was going to grow when we were here last quarter. So this is great news. And then looking regionally, we will start from West Coast and then move east. So in BC, that province faced a more challenging environment in the first quarter. In fact, it's the only region to fall below its historical average. The quarterly decline was driven mainly by a weakening business environment, reflecting job losses and slower wage growth in that province. There were cautious expectations for both cash flow and the broader economic outlook. And then on the credit side, this province saw rising bankruptcies and then higher supplier trade delinquencies. Alberta reported the strongest results this quarter, hitting the highest level since we actually began tracking the index. The results were largely driven by a sharp rebound in sentiment and a business environment that continued to strengthen. Employment and wage growth also helped set Alberta apart from the rest of the country. Growth projections were the primary area of concern in this province, though, as Alberta saw fewer business openings and declining investment and hiring, suggesting that Albertan businesses remain cautious about expanding in the near term. But as a major oil-producing province, the rising oil prices could provide a potential tailwind as the year unfolds, though. Next, Manitoba and Saskatchewan's index rose to 103.5, and this was the result of improving sentiment and growth projections as stronger financial trade openings and business openings pointed to improving activity. This region has a solid business environment supported by employment and wage growth in both provinces. Next, we look at Ontario, where the index rose to 100.6, and that was up 3.2% from Q4 and 1.7% compared to the same period last year, which pushed it above its historical average of 99.2. This recovery was broad-based, meaning that all 4 components of the index improved. Sentiment led the rebound as businesses reported stronger cash flow conditions, supported by continued growth in consumption in 2025 and improving economic expectations. The business environment stood out as a key area of strength, while growth projections and sentiment remained soft. Ontario avoided the worst in 2025. However, uncertainty remains elevated and new headwinds have emerged in that region. So we'll see how that changes next quarter. Quebec's index was also up, reaching 102.9, which is well above its historical average and its highest level in more than 3 years. Sentiment rebounded sharply from the steep decline experienced in Q2 2025, which is when the trade tensions weighed really heavily on expectations in that particular province. But as the economic impact of tariffs proved more limited than initially anticipated, businesses reported stronger cash flow expectations and a more optimistic outlook for the economy. Growth projections were the main area of weakness. Investment intentions and hiring expectations remained low, suggesting that many Quebec businesses had not yet turned their improved confidence into expansion plans just yet. And then in Atlantic Canada, businesses began 2026 with a more optimistic outlook. The region index rose to 100.0, which is slightly above its historical average. And this was driven mainly by stronger confidence. Businesses reported a more favorable cash flow position and economic outlook, suggesting that sentiment began to stabilize after several quarters of heightened uncertainty. But despite this renewed optimism, growth plans remained cautious. The business environment out east continued to weigh on the index, while declining businesses and financial trade openings restrained growth projections. And then, although the removal of Chinese tariffs on Canadian seafood products was not reflected in the Q1 data, it's expected to perhaps support activity in the coming quarters. Okay, next. I mentioned on the last slide that the index is made up of components, and then here on this slide, we see the breakdown of those 4 components on your right-hand side. And then on your left is how the index has trended over time, starting in Q1 2021, which is the benchmark quarter. This quarter's growth represents a 2.3% quarterly increase, and in fact, it's even higher than it was the same period last year, driven largely by the business confidence sentiment component that you see on the right-hand side. And that's because 2026 started off on a positive note with renewed optimism. The survey was captured prior to the outbreak of the conflict in the Middle East, so this might be a short-lived gain. But nonetheless, it does show that businesses were feeling optimistic in the first quarter. And then as the quarter progressed, the conflict in the Middle East brought back inflationary pressures as key commodity prices surged. The unemployment rate rose in Q1, labor market conditions softened, and as we talked about at the top of the webinar, our population began to slow, and those factors are expected to weigh on the economy's growth potential in the coming quarters. And then finally, looking at 2 of the key sectors of the economy here, we'll start actually on the right-hand side of your slide at the Retail and Wholesale Trade Index, which delivered the strongest performance this quarter, growing 6.2% from the previous quarter to 101.3. And this is its highest level since Q2 of 2022. And that was driven by strong gains in both the business environment and sentiment components. The share of businesses expecting worse economic conditions fell from 58% to 34%, and credit conditions improved with lower delinquency rates and reduced utilization. On your left is the manufacturing index, which increased modestly by just under 1% to 98.3, which continued the rebound that sector saw in the fourth quarter. Growth projections were the primary driver there, which is supported by business openings and trade activity, along with improved sales and hiring expectations. Financial access also strengthened, with 57% of manufacturers reporting that their financial needs were fully met, up from 44% the previous quarter. And despite these improvements, though, economic pessimism continued to weigh on this sector and amid rising commodity prices. And lastly, but the numbers are not on your screen here, but the construction index fell to a new record low of 90.4, which was driven by worsening credit performance, debt repayment constraints, and economic pessimism. Okay, so time now to dig into how all of that big picture stuff played out in terms of credit performance. There's been a slowing down of entrepreneurship as fewer people are seeking out new business credit. Debt pressure has risen, but not evenly, as higher risk and newer businesses are carrying more of the debt strain. And we'll also see that there's been a continued pronounced shift in borrowing as businesses are moving towards longer term loans in favor of shorter term, higher interest obligations like cards and lines of credit. And I believe we had a few questions that came in ahead of time that asked about various sectors, and we're going to start to dig into some of those trends. So you should see those answers coming up there, as well as some of the entrepreneurship numbers that's coming up soon too. Okay. So on the left-hand side of your screen, you're looking at balances across the different financial products. And then on your right is the average debt per business. So excluding mortgages, balances have declined significantly this quarter. Cards and lines of credit are both down double digits, 17.2 and 21.3% declines there. Installment loans have also showed a decline in balances, but less so by 5.2%. And then looking at the average debt load per business for each of those products, that massive shift that we saw last quarter looks to have sort of stabilized. Compared to Q4, the average debt load per business on cards and installment loans declined slightly, but then rose slightly on lines of credit. And this really illustrates how businesses have pulled back on those shorter term, higher interest rate products in favor of more structured borrowing. The concern remains that businesses are carrying more longer term debt. So if late payments start to rise on those obligations, it could cause deeper cash flow strain. And then looking at the average debt per business, it was marginally higher this quarter when compared to the same period last year. And then when we segment based on the age of business and on risk classes, we can see that the debt burden is largest for newer businesses, particularly those in their second year of operations. And there's double-digit increase in balances seen within businesses on those higher risk categories. So the concern here is for those businesses being able to sustain that increased level of debt load over the long term. This could point to future credit losses, closures, or restructuring pressures if economic conditions stay status quo. And then overall, commercial credit demand rose by 4% year over year. The demand for credit was concentrated at the center of the map as there was flat demand both in BC and in the Atlantic provinces. The only area to really pull back on credit demand was the Yukon Territory. Professional, scientific, and technical services had the largest declines, followed by finance and insurance, real estate, transportation, and warehousing and construction. And then the sector that had the highest demand for new credit was agriculture, forestry, fishing, and hunting, as most other sectors had basically flat growth. And given that farming and forestry require larger capital investments for heavy equipment, land, and fuel, and that type of thing, this increased demand isn't really surprising during this quarter when commodity costs were so much higher. Whereas sectors like tech and finance, they'd be able to manage through a stagnant economy by either delaying projects or reducing staff. Okay, so now let's look at originations. And these are the number of new accounts. So on the left, we've got the number of new financial accounts in the gray line, and then the number of new supplier accounts is in the red line. There's an interesting inverse relationship happening there this quarter. So for the past year, the number of new supplier accounts had been greater than the number of new financial accounts. But Q1 returned back to seeing a greater number of accounts stemming from financial institutions. And then when you look at the mix of those financial accounts on the right-hand side, you can clearly see the growth of those installment loans, which now makes up more than a quarter of all originations. And this really highlights that shift in borrowing away from those shorter term, higher interest products. The change has been happening slowly, but it really made a pronounced shift this quarter. And then here on this slide, you can see the impact that that shift has made on balances overall. Installment loans are typically used for large-scale, long-term investment, like purchasing heavy equipment or expanding infrastructure, as well as refinancing older, expensive debt into something more structured and manageable. These types of loans pull up the average credit limit when they hit the books, and that's exactly what we're seeing here. The average limit on new financial trades leaped up to about 97,000, while the average limit on new supplier trades actually dipped to approximately 32,000. In terms of credit scores, there hasn't really been too much of a change with financial trades originations, but with supplier trades, there's been a shift towards those lower risk segments, suggesting that suppliers are starting to tighten up their lending criteria. And then recapping the growth data in the first quarter, we saw that debt levels weighed heavily on newer and higher risk businesses, while the average debt per business tilted more heavily towards longer term structured debt. Demand for credit was up by 4%, and that was driven largely by agriculture, as there was declining demand in the professional services, finance, and real estate sectors. Quebec had the strongest demand for credit with an 8% increase year over year, with BC experiencing flat year over year growth in inquiries. That's also noticeable as BC was the only province to see a drop in the business health index numbers, falling below its historical average. Okay, so now we're going to take a look at the delinquency trends and see how things evolved with missed payments this quarter. We're going to try. There we go. Oh, no. There we go. Okay, industrial trades up first. No, I think I'm still, there we go. Now we're here. Okay, so on this slide, we're looking at delinquency rates in the first quarter since 2022 on the far left. It keeps it fun and checks to see if you're paying attention. That's what that does. And then on your right, we're looking at the 90-plus day delinquency rate for financial trades represented by the blue line, and then the supplier trades are represented by the red line. So I suppose we'll start by examining the graph on your right, because that is one trend line that's just jumping off the page, if you ask me. For the first time since we've been tracking these numbers, delinquency rates are moving in opposite directions. The severe delinquency rate on banking trades is now higher than the severe delinquency rate on supplier trades. And this is where you would click the shocked emoji to come floating up. Financial delinquency rates, there you go, have climbed to a peak of 3.6 this quarter, while industrial delinquencies have dropped to a low of 3.1%. And then once again, this really illustrates that businesses are actively prioritizing critical supplier payments over institutional bank debt. It's entirely possible, too, that some of the debt consolidation we saw earlier with the shift in balances has freed up cash flow to facilitate this change in trend. And then now if you look at your left-hand side, you can see that the impact that this crossover trend is having overall. Lenders and suppliers have really concentrated their new account originations within the safest credit tiers, which has had the effect of insulating the market from higher default rates. So after peaking in early 2025, the total number of businesses in delinquency saw a double-digit drop in Q1, falling 10.4% year over year. Okay, drilling into the industrial trades a little more, we can see this improvement is happening across all severity levels. So the 30 plus, 60 plus, and 90 plus days past due. And actually, the sharpest decline is visible in that 30-day bucket. Overall, this segment is in a much healthier state than it was a year ago. If you look at the segmentation on the right-hand side of the screen, Here we're breaking down those rates by age of business. And you'll see that the new entrants, so those are the newer 48 months and below, they're performing exceptionally well, dropping from a 7.8% delinquency rate to a 3.3%, which really highlights the caution that supplier lenders have actually taken. We also see healthy declines in the mature business segment, but it's that middle area that represents the highest relative risk, sitting in the low 6% range. And then when we look closely at the financial trades, another thing that stands out, apart from the rise in the delinquency rate, is the concentration of the 30, 60, and 90-day trend lines. So the compression that trend indicates, it indicates a low cure rate, meaning once businesses fall 2 months behind on their financial obligations, they are highly likely to roll into severe delinquency rates rather than catching up on their payments. Regionally, this deterioration is happening across every province. Ontario displays the highest delinquency rate, rising to 4.2%, which represents a 14% increase. And although Alberta has the next highest rate at 3.7%, the increase there was not as pronounced as what we see in other provinces. Out east, PEI, Nova Scotia, and Newfoundland saw rises in delinquency rates to the tune of 22, 19, and 14% respectively. Okay, and then breaking those financial trades down once again by product type, installment loans displayed the sharpest and most concerning increase in delinquency rates. After a slight dip in 2025 to 3.09%, installment loan delinquencies sit just shy of 4% at 3.98, which is a 29% increase. Lines of credit increased slightly to 3.22%, and cards jumped up 10% to sit at 3.86. And this is a trend that lenders really need to watch closely, as installment loans now represent the highest risk category. So looking at the numbers by age of business, there's nothing that really stands out too dramatically here. The delinquency rate increases spread out across all age cohorts. A few things to note is that the risk profile increases with the age of the account, and that the newest businesses sit at 1.15% delinquency rate, while the businesses older than 48 months display the highest at 4.35%. And then finally, when we look at those delinquencies by sector, we can see that the sectors with the greatest strains kind of coincide with that drop in demand for credit that we saw earlier. The financial trade delinquency rates rose compared to Q4 in every single sector. Accommodation and food service reported the worst of it, as it rose to 6.4% in that blue line on the left, followed by transportation and warehousing in red, sitting at 6%, and then retail trade in yellow at 4.8%. And then the sectors that were lower than the national average, that's on the right-hand side, just like we saw with the increase in demand for credit, that red line at the bottom on the graph, that's the agriculture, forestry, fishing, and hunting sector, which rose to 2.2% after displaying a couple of quarters of declining delinquency rates. All right, we are now in the home stretch of the trends data. And lastly, we're looking at the insolvency data. And then unsurprisingly, I suppose, the insolvency rate increased nearly 10% this quarter as both proposals and bankruptcies rose. This was true in each province, and while we have seen increasing insolvency rates for the last 2 quarters, the numbers are actually lower than last year. Okay, so recapping the data from the first quarter of 2026, we saw a sharp split in credit performance as there was a divergence between rising financial trade delinquencies and falling industrial trade delinquencies. The average debt per business pressure was distributed among the higher risk and newer business categories, mainly those in their second year of operations, while the average debt per business stabilized in the mature business segment. And that pressure is mounted And as that's happened, we've seen a rise in insolvencies nationally compared to the previous quarter, although the insolvency rate is lower compared to the same period last year. And then, so what can lenders be thinking about in this sort of an environment? Well, for financial institutions, one of the areas of concern that we saw was that concentration of delinquency rates between the 30, 60, and 90 days. And so for that reason, lenders are going to want to ensure early intervention outreach. Review your portfolios carefully, as the credit pressure it's not evenly spread evenly across all sectors. Delinquency rates varied significantly by industry and by region, as well as risk tier. So you don't have to go looking for a needle in a haystack. Proactively review your portfolios within these pockets where losses, closures, and restructuring pressures are the most likely to emerge. We talked earlier about the declining numbers of new businesses in Canada. And at this point, I'd like to introduce my colleague, Gianluigi Duella, Senior Director, Scoring, Engineering, and Insights. Gianluigi brings over 20 years of experience to scoring and analytics, and we had the great fortune of having him join Equifax last year. So recently, he and his analytic team have been hard at work uncovering new insights that have been buried deep in all the data that we have at Equifax, specifically focused on that entrepreneur segment that we talked about. Gianluigi, thank you for joining me today, and I'll let you take over from here to share the incredible insights that you and your team have uncovered. Over to you.
Awesome. Thank you so much for that introduction, Sinead, and for that fantastic and in-depth overview of the commercial credit landscape. You know, it is really challenging environment for commercial lenders and businesses these days, as if in normal times, commercial lending and running businesses wasn't hard enough. But now we get to switch gears a little bit and look down the road and talk about some new and exciting insights that may make things a little easier for both. The business principle. Consumers who are built differently. Business principals are not general consumers. Their entire relationship with credit is fundamentally different from the average individual consumer. And an understanding of this difference is the key to unlocking new value. This is where we see the biggest opportunity to innovate and support the future of commercial lending at Equifax. Let's dive in. When we talk about business principles, we're talking about individuals facing an immense personal and professional pressure. Common stressors within the day in the life of one are the responsibility overload, owners juggling every role from CEO to customer service, and the constant switching of contexts and hats, as they say, and having total accountability for all decisions lead to significant attention and time, as well as exhaustion in their day-to-day. Staffing and team management. Finding, training, and retaining dependable employees requires investments of time that are already at a premium. A bad hire or turnover directly impacts operations, profitability, and the ability to meet customer expectations, which in itself involves a continuous strain of providing top-tier products or services to stand apart from other competitors, handling complaints, and upholding a professional image all at the same time, all of which demand significant amount of emotional energy. Even their work-life balance is different. The business is deeply tied to the principal's personal livelihood. Switching off is incredibly difficult. Principals work long hours, forgo vacations, and isolate themselves oftentimes, which drastically accelerates burnout. A business principal's life is certainly not for everyone. And if that wasn't enough, on top of all of this, the most acute and constant stressor, which is financial instability and cash flow. This relentless worry about payroll, vendors, and sometimes sacrificing their own salary to keep the business afloat is really what sets them apart from the average consumer. This is where Equifax, whose mission is to help people live their financial best, can step in. Now, on the other side of the desk, a commercial lender's decision to extend credit to small and young businesses is not easy. Evaluating high risk, high exposure opportunities is not easy. Strict regulations compel traditional lenders to tighten credit, often excluding seemingly risky businesses. High opportunity costs make smaller loans less profitable. Anecdotally, underwriting a $50,000 loan requires the same resources and due diligence as a $5 million loan. High failure rates among small businesses naturally make leaders cautious about releasing their capital into the market. Early stage companies do not have years of audited financial statements, which makes it very challenging for lenders to verify steady repayment capabilities. Further to this, small, younger businesses often lack tangible assets like real estate or heavy equipment to pledge as loan security. Traditional lenders almost always require owners to sign a personal guarantee, risking personal assets such as their primary residences. And deeper still, for younger businesses, a heavy reliance on the principal's personal credit score muddies the waters. When owners use personal credit lines to cover business operational gaps, a vicious cycle takes form. Their personal scores inadvertently lower, move in the direction of the limits of lenders' credit appetite. So with all these challenges we just outlined, high risk, lack of history, the blurring of personal and business credit, make it clear that assessing credit is uniquely difficult for business principals of younger and smaller businesses. We at Equifax know that blended scores, combining personal and commercial insights into one assessment, is the end game. With the investment in AI, in the cloud and AI tools available to us, we have created custom blended score solutions, and the results are quite strong, and the feedback has been quite positive. However, there are some investments required to deliver such benefits to the broader commercial lending industry at scale, and it will take some time for us to get this right. So nevertheless, we are making those investments. But at that moment of realization, we, analytics, data, product teams, consulting teams, gathered and allowed ourselves to ask some questions. Are we on the right path? Are we on the right path to serve this critical segment, given the challenges of the current environment? Are we doing everything we can right now? One of my funner moments at this company, as Sinead mentioned, it's been relatively short tenured, applying a first principles approach. We allowed ourselves to challenge several constraining myths here, rapidly testing some hypotheses and in the absence of explicit indicators. Failing fast but learning quicker was our objective. And without delaying any longer, we were quite excited to share that we discovered the business principles segment, the ability to determine who is a general consumer and who is a business principal consumer within the personal credit data. This discovery enables us to convert the anecdotal myths to facts. Business principals are forced to use personal credit heavily. Compared to the average consumer, this segment carries a 31% higher utilization across all trades, has 105% higher balances on their personal credit, and manages 44% more trades. This data clearly demonstrates a disproportional dependence on personal credit to secure timely funding and sustain business operations. Going a bit deeper, this segment's behavior is driven by an acute need for cash on demand and leveraging personal equity to support their businesses. This is evident in their aggressive use of certain credit products. We see high percentage of differences across both revolving credit and HELOCs, home equity lines of credit usage. This financial fingerprint, characterized by seeking immediate liquidity, further reinforces our position that traditional consumer credit models are likely being misapplied to assess the risk of people running businesses. This brings us to the core opportunity, risk assessment. Supporting our position that simply applying a standard consumer credit score to a business principal is not optimal. This is because their credit behavior is so distinct, as we've shown. Driven by business needs rather than purely personal consumption, a score optimized for the general population underperforms for this segment. We see up to a 32% relative difference in risk to consumers in what is considered the lowest risk consumers. This is quite material when generally the lowest risk customers also receive relatively larger loan amounts. A better assessment that accounts for the reality that their personal credit data is inextricably linked to their commercial activity is required. Now, the fun part. On the right-hand side, please go back slide. On the right-hand side are very early preliminary assessments, not yet what I would consider a minimum viable product, so very much a prototype. Suggest that there's at least a 10% lift in performance here, capturing 3/4 of the bads instead of only 2/3 in the riskiest 20% of the business. And that, just to be clear, a bad is defined as going 90 days delinquent or worse in the next 12 months. So put differently, lenders can expect a loss savings benefit and or opportunities to approve more and grow their commercial lending books with these insights that we're aiming to deliver to the market. So I am happy to share that coming soon in Q3, the business principal score for commercial lenders. Our first step in our roadmap towards the ideal, the blended business link score, a foundation to developing confident commercial credit risk assessments for small and younger businesses. The business principal score will provide higher accuracy. As I mentioned, standard consumer risk scores underperform when the data patterns differ from the majority. The relative risk gaps of traditional consumer scores will be cleaned up, that delta that I showed you. Distinct drivers, because we're isolating this population, we can identify variables that predict risk for this segment that are otherwise not considered. Either they or may have different weights or possibly even the opposite effects compared to the general population. And thirdly, higher efficiency. With a purpose-built risk score, providing more reliable and consistent actionable insights for tailored decision-making for commercial loans, this targeted solution will allow lenders greater confidence to serve deeper and more effectively in this critical market. And we'll be happy to provide more of this information on this development as we progress. So just a little teaser of what's coming. And so I want to thank you all for your time today, tuning into this section of the webinar. Sinead, back to you.
Amazing. Thank you so much, Gianluigi, for those insights. It was so fun sort of working through the process where we had these theories and hypotheses and, the stuff that we've kind of always thought and had hypotheses about, and seeing it real life come through in the data. That was really exciting. So your team has been doing some amazing work, and we can't wait to see the score come to life.
It's been a lot of fun.
Yes, it certainly has. Okay, so I think we have some questions, and bear with me as I try and navigate through this this new platform that we've got. So let me see if I can. I think we did have some questions that were asked about the segmentations in terms of sectors. So we've answered some of those. Do our business credit reports give us a forward-looking probability of default for businesses? They sort of do, yes, because of our predictive credit scores. There's a couple of different products that we have when we talk about the automotive leasing sector. There's an absolute probability of default there. But yeah, our scores is what I would point you towards. Are we seeing stress on older or more established businesses? Yes, I would say that we absolutely are. We're seeing those increased the missed payments happening even at the older segmentation, the older business level. So it's kind of been broad-based, if that answers your question. Let's see. Where are opportunities for growth in the Canadian market? I'm not sure. I think there's going to be so many different opportunities that open up in the coming months and coming quarters. I'm reading stuff as it flies in, so I'm not answering this great. But I would point to some of the programs that are opening up in terms of investment from the government, and that's probably many of the areas where we're going to see some investment happening over the coming quarters. And I think perhaps that I will leave it there because I'm not doing a great job of reading all of the questions that are coming in, and I will get used to this new environment later. So I apologize for that, but we will go through all of the questions, and what we'll do is we'll reach out to folks individually with answers if we're able to. So I think what I'm going to do, we'd love to hear your perspective. Please take a moment to help share the future or shape the future of these sessions. I think you can see this. I don't know. I'm getting some fly-ins. And I don't know. So you know what I'm going to do? I'm going to let you guys go have 10 minutes so you can grab a coffee before your next meeting. But I want to thank everyone who joined us today. Hope you found this hour well spent and that you've come away with some insights that are going to help strengthen your business strategies. We really appreciate the time that you spend with us each quarter. Thank you to all the behind the scenes folks here at Equifax. We really have an awesome team of people that bring this series to life every quarter. And with that, I'll let you all get back to answering emails, attending meetings, strengthening your strategies, and hopefully fitting that coffee or tea break back into. And I'll see you all next quarter.